Welcome, and let us look at how to record transactions in a journal. Let us look at the background of journaling. What are journals? Journal is simply a diary of chronological or a series of events of transactions as they happen in an organization. Journaling is the first step and the earliest record of any transaction in an organization. There's a difference between a journal and a ledger account. A ledger is where we have the T accounts where all the transactions are grouped into their respective accounts, unlike the journals where they are just put all together in a chronological event. In a ledger account, they are grouped into specific accounts where they belong, and those balances that we are obtained from the T accounts are then further used to make or to prepare the financial statements of an organization. Let us look the process of recording a transaction. We have the journal entry as first step. Then we have those T accounts in a ledger account as the second step. Then we have the last steps where we prepare the financial statements of an organization. Today we are looking at the journal entry. Let us look at the journal entry. As we said, any business transaction must be recorded in a journal, and that's the best accounting practice that any organization must follow. Now, in a journal entry, we have five main parts. We have the date, description, the name of account, debit, and the credit columns. Let us look at the sample format of a journal. As we said, the main parts are date, description, the name of the account, debit, and the credit column. So that's how a journal will look like in a simple format. There are six categories that are affected by a transaction. Those main categories of accounts include the assets, expenses, revenue, dividends, liabilities, and equity. Let us look at what a transaction does to those six main accounts we have seen. An increase in an asset, expense, or a dividend is a debit. An decrease to an asset, expense, or dividend is a credit. Effects on liabilities, equity, and revenue. And an increase to liabilities, equity, or revenue is a credit, and an decrease to liabilities, equity, or revenue is a debit. Let us look at one of the main principles of accounting, which states that a transaction must affect two accounts and it must be recorded in those two accounts that are affected. A transaction must affect the debit and the credit side. In recording an entry, an accountant must determine which of these accounts are affected. After that determination, he must understand whether that account is either increased or decreased, and that leads to what we call debiting or crediting. Let us look at a scenario such that we can understand what we have talked about. Let's say we have Minto IMC, and on January 10, it bought goods worth 500,000. On January 15, it sold goods worth 55,000. On January 20th, it sold merchandise on credit for 45,000. And on 25th, the company bought equipment worth 35,000 and in cash. On January 27th, the company paid a loan worth 50,000. And lastly, on 30th, the company paid employee salary of $20,000. Let us practice identifying accounts that are affected. For the first transaction, Inventory increased by 500,000 and is debited, and accounts payable increased by 500,000 and is credited. For the second transaction, cash increased by 55,000 and is debited, and sales revenue increased by 55,000 and is credited. For the third transaction, the accounts receivable increased by 45,000 and is debited, and the sales revenue increased by the same amount, 45,000, and is credited. Let's move forward to the fourth transaction. Equipment increased by $35,000, which is debited, and cash accounts decreased by 35,000 and is credited. On the fifth transaction, accounts payable decreased by 50,000, that's debited, and cash account decreased by 50,000, which is credited. On the last transaction, salary expense increased by $20,000, which is a debit, and the cash account decreased by 20,000, which is credited. Having identified, let us put that in the journal entry table and see how it appears. That's how it appears. We will have all those transactions just copied down. You can see on the dates where each of the transactions appeared. Then we have the description column briefly describing what the transaction is about. Then on the accounts, you can have, as you can see, we have two accounts that were affected by each of the transactions in on the description portion column. Then for each of the accounts in the accounts column, it's either debited or credited. And as we saw in the previous identification of the accounts affected, we identified that the first transaction, inventory, increased by 500,000 and the accounts payable increased by 500,000, which is credited. We have come to the end. If you have any comments or questions, please reach out to us and we will be able to help you out. Thank you.